Hello, and thanks for tuning in to this week's Signature FD Investment Audiocast, which we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start this week by looking at market returns from last week. It was a significant week from a macroeconomic perspective. Commodities rose by about 1.8%, 10-year bond yields increased to just over 4.2%, and the US dollar strengthened, gaining 0.8% on the week. And these are all forms of macroeconomic headwinds. And with those headwinds, the S&P 500 corrected somewhat, losing about 90 basis points. However, the index is still up 23% for the year. Small cap stocks and international stocks led the decline as they're more cyclically sensitive, with small caps down about 3% and international stocks down about 2%, which does align with those tough, difficult macroeconomic factors. Now, on a positive note, consumer discretionary stocks were up by 0.9%, which was a positive development. Despite the corrective market action, market breadth's been holding up well. Market breadth refers to the percentage of stocks, industries, and global indexes that are making new highs or are in uptrends. Now, our friends at Ned Davis Research, they highlight the percentage of stocks hitting new 52-week highs, and they compare that to the percentage of stocks hitting new 52-week lows. And at the end of September, that metric reached a new high water mark for this cycle, suggesting more stocks are making yearly highs than stocks making yearly lows. And that's significant because new highs have historically peaked a median of 39 weeks before the end of a bull market, indicating that the market may still have room to grow from a breadth perspective. Now, looking at last week's economic data, we continue to observe a tale of two different economies. Sectors more dependent on goods manufacturing, those are experiencing a mild contraction at best. In contrast, service spending continues to drive this expansion. This dichotomy is evident in the Conference Board's leading and coincident economic indicators that were released last week. On Monday, the leading economic indicator showed a decline of 0.5%, primarily due to weakness in manufacturing, an inverted yield curve, weak consumer expectations, and weakening building permits. Despite more indicators in the leading index improving, those four factors were enough to drag the composite down. Now, contrast that with the coincident index, which indicates the current state of the economy, and that index continued to rise. And now the Atlanta Fed's GDP Now calculation for the third quarter currently estimates a 3.3% growth rate for the third quarter. That's a pretty strong rate of growth. Now, we also receive flash Purchasing Manager Index readings, or PMIs, which measures from S&P Global. And those showed that the composite PMI was up to 54.3. Now, with 50 being the line between expansion and contraction, a reading of 54.3 is pretty robust. And that was driven by a 55.3 reading in the service sector. However, manufacturing remains in a contraction at 47.8. The divergence between these economic sectors cannot continue indefinitely, but easier Fed policy and the resolution of election uncertainties may help struggling sectors to recover in the months ahead. Now, one potentially surprising development is the aforementioned rise in interest rates, and that's despite the Fed's 50 basis point cut in September. The rate market has been priced for cuts all year, and the 10-year Treasury yield range from 4 to 4.5% actually probably aligns well with the Fed's terminal rate of 3%. Additionally, inflation break-even spreads are rising, likely due to two factors. First, economic growth has been surpassing expectations, causing market concern over the Fed's ability to execute on their planned rate cuts. And former President Trump's increasing probabilities of winning in the betting markets, that's also leading to expectations of potentially a higher forward inflation environment due to higher deficit spending, decreased immigration trends, and tariffs. Now, markets often misjudge these factors in hindsight, but that is the current market pricing. For this week, we're focused on jobs data, starting with the job openings and labor turnover survey, or the so-called JOLT survey, on Tuesday. ADP reports on Wednesday, and jobless claims are on Thursday. The official BLS employment situation report comes out on Friday. Now, we expect this data to be somewhat soft because we had 2 hurricanes and there's been strike disruptions. Now, additionally, we have the personal income and spending report on Thursday, which includes the Fed's favored PCE price index for inflation. There's plenty of market moving data to watch, and we're also going to continue to monitor developments in Israel and Iran. Currently, oil markets are correcting to start the week as retaliatory strikes have been limited to military targets rather than oil targets. So be on the lookout next week for our take on all the job data from this week and that PCE inflation data, and potentially any election implications that we see. Until then, thanks for joining us and have a great week ahead.